Hello students. Uh, Next we are going to do another question and answer session on the lease IFRS 16, SLFRS 16. Okay. In the question directly we will go to the question. In question, street based on item of equipment for a period of 5 years. Street leased an item of equipment for a period of 5 years from the start of its financial year, 1st January 2019, right? An initial payment of 4,000 was made on 1st January 2009, right? Lease, lease, lease starts on 1st January 2019, right? And lease period 5 years, right? Initial payment 4,000, right? Initial payment 4,000 made on 1st of January 2008, and then a series of 4 future payments were made each year on plus 4 future payments, plus 4 future payments, right? Future payments made on each first. The rate implicit in the lease is 3% and the present value of the future lease payments is 14,000. Rate of implicit sit 3%, present value is 14,868. 14,868. Useful life 5 years. Useful life full life 5 years. Extracts of required prepare the extracts of the financial statement at the end of the financial year of 31st December 2019, right? 31st 31st 12 2019, 31st 12 2019, right? Financial statements, they required us to prepare the financial statements, extract, right? The as per the lease starts on 1st January 2019, period of 5-year period, initial payment 4,000, right? 4,000, present value of future payments, right? So here you'll see year 1 years, right? Then brought forward balance, right? And payments, right? Other thing is capital, then finance cost, carried forward balance, right? Carried forward balance. So they have given here year 1, year 1 and year 2, right? Year 1 brought forward balance should be, right? Carefully, you have to carefully read the question, right? They have said, okay, the street leased an item of equipment for a period of 5 years from the start of financial year. 1st January, one payment is gone for 5,000 on 1st of January 2019, and series of four future payments were made each year on 1st January. The rate implicit in this lease is 3%, and the present value of the future lease payment, present value of the future installment is 14,000. So we have paid an installment of 4,000, so we had to add 4,000 with 14,000. So brought forward balance is for 18,868. Payment is 4,000. So you will get 22,868 is the amount. So 3%, if you say you have to deduct it, okay, then only 14,868, right? Then 3% on 14,868 is 446. If we add 446 with this 4 and 1 5, down 1 5 13 and 1 15,340. Then 15,314 is the brought forward. If you add another 4,000, then capital would be 11,340. On that, if you applied 3%, right, 3%, 339. If we add this 339, 3 and 1 to 5, six 11,653. 11,653 up to year 2 calculation, right? If you want, you can go up to 5 years, because in the question they have asked up to 31/12/2019, right? So here we can identify the finance cost, right? Cost of the vehicle, cost of the equipment, and payments, right? Thereafter we had to calculate the depreciation. Depreciation is how much the value? 18,868. How many years useful life is? 5 years. 5 years. So what is the amount? Amount is amount is 3,774. Amount is 3,374. Right here, depreciation for the year is 3,774. Right, in the non-current assets, we have to say property, plant, and equipment. Property, plant, equipment. Right. What is the present value? Present value is 14,000. Right. Present value 14,868. Right. Plus calculation of property, plant, equipment. Right. Calculation of property, plant, and equipment. So, property, plant, and equipment. We don't need to do it separately because it is not final accounts. So here itself I will show property, plant, and equipment. Right. This is present value. Value is 14,868 plus installment initial installment, that is 4,000, right? So you will get 18,868 minus depreciation, that is 3,774. Then what is the amount? Is 4,16,9,0, right? 0 15,094. Property, plant, and equipment, you will show at property, plant, and equipment 15,094 under the non-current assets. This equipment, right? And non-current liabilities, under the non-current liabilities, you will show lease creditors. Lease creditors. How much the lease creditors? Right? 14,068, 14,000 and 868, right? 14,868, these creditors, minus 4,000. No, no, no. 4,000, okay. Minus 4,000. That is, that is equal to 10,868. Right? 10,868. Lease creditors and lease interest. Lease, right? Lease creditors and lease interest. Lease creditors 339, interest 339, 4,000 minus 339 is 1 3, no, no, 6 6 and 6 plus 3,661, right? 3,000. Sorry, 14,008, not 14, 15,000, 15,000, 15,314 minus 4,000, it is 11,000, 11,340, 11,340, right? This is 15,000 and we had add the cost of this also, no? Right? So first year we have finished. Second year 3,161 plus 339, right? That is these interest payable 339 and these creditors 3,661 payable. That is 4,000. That is 4,000. That is we deduct this one from this comes. Otherwise you can put all together saying this as a lease liability or lease creditors, lease liability or lease creditors, lease liability. 4,000. Lease liability is 4,000. This is lease liability. you can say either lease liability, or you can split it and show lease creditors 3161 and lease interest 3339, and altogether it should be 4000. This is how you had to show in the balance sheet. In the balance sheet, non-current assets, under the non-current assets you had to show 15,094, whereas present value is 14,868 plus interest installment, first initial installment 4,000, then 18,868 minus depreciation, written down value, no? So you will show the written down value in the current assets. So if you deduct the depreciation, then 15,094 is the property plant equipment. Under the property plant and equipment you will show this particular equipment 15,094. Non-current under the non-current liabilities, lease creditors 15,314 minus 4,000, that is 11,334 is the 314 is the liability, right? That is the long term liability. This 4,000 is the current liability, that is lease creditors 3,161 and lease interest 339, or lease liability altogether you can say 4,000. This is how you have to split the lease creditors of 15,314. You have to split and show it, non-current and current. Next year lease credit payment installment is our current liability. Next year lease current payable is current liability for us. That's what we are showing separately as current liability, right? So if you add these two, then you will arrive at 15,314. 15,314. This is the 15,314, right? Instead of showing in one balance as a 3,000, you have to split it and show. This is falls under the long term. This is falls under the current, under the 12, within the 12 months period, right? That's what we are split it. Okay, understood? So next we can move into the uh, sale and lease back. Okay, so next question, in lease IFRS 16, SLFRS 16, that is lease, right? In lease we have seen earlier the measurement and initial measurement and subsequent measurements, right? And now we will see sale and lease back. Sale, lease only we have seen, now sale and lease back, right? Sale and lease back. In the sale and lease back, if the transfer is not a sale and lease back, can you understand what is the sale and lease back? Sale and lease back, sorry. Hi students, how are you? Today in this session we are going to continue the lease IFRS 16 and SLFRS 16 lease, continuation of previous lesson. So in the lease, sale and lease back, today we in this session we are going to see next one is sale and lease back. That means sale and lease back. What is the meaning of sale and lease back? Sale and lease back in the sense X is having a property or property, we would say property, that is land, right? He has a land Now he wanted to expand his businesses, right? But he doesn't have enough money. He doesn't have the enough capital to expand the business. So what he did was he wanted to lease out his own, sell and lease out, because he want the land and building. If he sell this land and building, he cannot run his business. So what he did was he decided to sell the land and building to X decided to sell his land and building, sell the land and building to Y, and decided to lease it back. Lease. He in return he got it on the lease, lease on lease of 10 years. 10 years for some consideration of money. For some consideration of money, he sold it to Y, X, and lease it back the same property, right? Sold it and lease it back, because he doesn't want to sell it to anybody, but he want the money for the capital, infuse the money to the capital. So for that purposes he sold it and lease it back. So this activity is called as sale and lease back. This activity called as sale and lease back. Understood? Sold and lease back. Lease back, at the end of the lease contract he will get the ownership. Sometimes he won't, sometimes he will get. That depends on X and Y, right? So sale and lease back, this is what we call sale and lease back. Ownership of the property you may get or you may not. That depends on both of their agreement. That's what we decided to see sale and lease back if the transfer is not a sale. If the transfer is not a sale, that means sell it and lease it back, and end of the year you will get the property, the ownership. Then the seller is the lessee, sold it and got it back as a lessee. He is the seller, initial seller to buyer. Again buyer become a lessor by leasing out the same property, sales and lease happening, sales and lease it back. That's what seller, he is a seller, X is a seller and lessee. In his books, if it is not a sale, continue to recognize as the asset as usual. There is no change. Usually what is the accounting treatment you will do, it, right? If it is not a sale, recognize a financial liability. So you recognize as an asset and financial liability, recognize it. So on the part of the buyer, that means lessor, bought it and leased out, no? Do not recognize the asset. Do not recognize it as the asset. Recognize the financial asset. Only the financial asset. Right? Second one is, if the transfer is the sale, if the transfer is the sale, lessor, seller and lessee. Seller and lessee has to do so many adjustments. Seller and lessee. This is the abnormal happening, seller and lessee. If the transfer is not the sale, is the sale. If the transfer is the sale. On the part of the seller and lessee, de-recognize the asset. De-recognize the asset. First de-recognize. Here transfer is not a sale. Not a sale. They just transfers take place. Here transfer, if the transfer is the sale. So first you have to recognize the de-recognize the asset. Again, recognize the sale at fair value. Recognize the sale at the fair value. Recognize the lease liability. Lease liability. Recognize the lease liability at the present value. Recognize the right of use asset as a proportion of the previous carrying value of the underlying asset. You have to recognize the right of use assets as a proportion of the previous carrying value of the underlying asset, rights of the underlying value. And you have to recognize the gain or loss on rights transferred to the buyer. Gain or loss on the rights transferred to the buyer. On the part of the buyer or lessor, recognize purchase of the assets. Recognize the asset. Purchase. Apply lessor account. Right? Apply the lessor account. So, we will discuss, I am going to raise this one. We will discuss a question where we do the fair value. Right? Under the fair value. Okay. Fair value. Right? In the question, Apple, in the question number 3, right? Question number 3 said, A required funds to finance a new ambitious rebranding exercises. He need the finance to finance a ambitious rebranding exercise. It is only possible way of raising finance is through the sale and leaseback of its head office building for a period of 10 years. The lease payments of 1 million are to be made at the end of the lease period. The lease payments of 1 million are to be made at the end of lease period. Right? End of the lease period. Right? The current fair value of the building is 10 million. Right? Fair value, carrying value is 8.5 million. Fair value 10 million. Carrying value 8.4 million. Right? 8.4 million. Fair value 10 million and carrying value is 8.4 million. The interest rate implicit in the lease is 5%. Interest rate. Interest rate 5% implicit. Right? 10 years lease term, 10 years. Right? 10 years. So, advice A on how to account for the sale and leaseback in its financial statements in the office building were to be sold at the fair value of 10 million, and A, performance obligations are not satisfied, or B, performance obligations are satisfied. Performance obligations are not satisfied in the sense the transfer is not a sale. Performance obligations are satisfied in the sense the transfer is the sale. Right? Under A, under the A, you will recognize the asset, right? Recognize the asset on 8.4 million, right? And depreciate it, and depreciate, right? Second one, recognize the liability. Recognize the liability at 10 million and amortized, and amortize it. Right, amortize the cost, right? Amortize the cost, right? So in the A, recognize the asset 8.4 million as an asset and depreciate on the based on the 8.4 million. Recognize the liability as a 10 million. 10 million as your liability and amortize it cost, right? Second one is B, that is normal. I am not going to do it. Liability. B, right? The performance obligations are satisfied. These performance obligations are not satisfied. In the B, we are going to see total value. Total value, right? Value one is 10 million, other one is 8.4 million. 8.4 million, right? Total value, right? Then rights of use, rights retained, right? Rights of use retained, right? Rights of use retained. Wait, I'll check whether, right? Rights of use retained, right? Here, rights of use retained, you have to see, right? 10 million. For the 10 million present value, what is the present value for the 10 million? Right? You refer the table. Right? Go through the tables. The table 5 years, 10 years, period is 10 years and 5%. 7.722. 7.722, right? 7.722, right? 7.722, right? So 7.722 into 10 million. 7.722 into 10 million, right? 2 into what do you call? That means 7,722,000, right? Right? So this is that, and next one is rights of use retained, rights of use transferred, rights of use transferred. Balance is the 2,282,288 is a right issue used, right to use transfer, right? This is, we had to refer the table 7.22, got it from the present value table, into 10,000, 7,722,000. Balance is right of use transferred, right of use transfer, use transfer, right? This is my, this is 100%, this is 77.22%, this is 22.88%, right? So we had to calculate, right, 84,000, 8,400,000 into 0.7722, then it will come around 6,486,480, 6,486,480, right? It is 402 to 7. What is that? 7.722. Right. 476.480 it comes. 8,400,000 into what is the percentage? 77.22%. 6,486,480. Right. Right. And if you put 22.88 percentage, and then you will get 1,921,920. 13 and 5 20. Okay, this is what we calculate, right? So this is the amount. Now we have to pass the entries, right? First of all, we have to record the proceeds, right? What is the proceeds? Record the proceeds. Proceeds. Proceeds, right? Proceeds. Record the proceeds, right? Record proceeds. What is the proceeds? Bank, cash, or bank debit. Proceeds we have to recognize. Cash or bank, it has to be debited. How much we have to recognize? 10 million. How much we had to recognize? 10 million. 10 million proceeds, and de-recognize the asset. The asset, right? De-recognize the asset. Recognize the sale. De-recognize the asset. De-recognize the asset. Right? How do you de-recognize the asset? Asset account. De-recognize the asset. That is asset account. That is asset and or property, plant, equipment account. This is debit 10 million. This is credit 8.4 million. That is de-recognize the asset. Asset value is 8.4 million. Carrying value. Carrying value, we are de-recognizing the carrying value. We are transferring a 10 million present value. Right? Fair value 10 million. Value debt. And then proceeds at the fair value, no? This is done at the fair value. Fair value is done at the fair value. The carrying value is 8.4 million. That is carrying value of books. 8.4 fair value. valuation of fair value is 10 million, right? 5% interest, right? So derecognize first, we recognize the sale by receiving the cash proceeds 10 million at fair value, and we are derecognize the assets 8 million 400. Now recognize the lease liability. Recognize the lease liability. Recognize the lease liability. Liability is what is the lease liability? Credit. What is the lease liability? Rights of use retained. Lease liability is rights of use retained. This is the our lease liability is this 7,722,000. So recognize lease liability is this. After that, recognize the right of use. Recognize the right of use. Recognize right of use. Recognize the right of use, that is the asset account, right? Asset account. This is de-recognizing asset. This is asset or property, plant and equipment. Right? Account debit. This is the recognize the right of use. That is 8,400 into 77.22. That is debit 6,486,480. Right? This is the recognize the right of use. And final is gain or loss. Gain or loss is equal to, that is, we'll see which side is more, right? Side is more. This is the balancing figure. Okay, this is balancing figure. Balancing figure, right? Take down it's the balancing figure, right? To say 8,400,000 plus 7,722 is 16,722. 16,720. 16,122, right? 122, right? Minus 16,486,480. 3,064,000. 3,064,000. That is 3,064,480. Right? 3,064,480 is the gain. This is the gain. This is credit balance. Gain. This is right. This is the balancing figure. This is the balancing figure. Right? Finished. We have completed one question. Question number 4. All the facts are as it is in the previous question, but they have mentioned here, they have the question is different, right? Question is different, the facts are same. Facts are same, right? Now they are, what they are asking is advise A on how to account for the sale and lease back in its financial statements in the performance obligations are satisfied and the building is sold for the following. One is for A is for 9 million, B is for 11 million. We have to do the accounts for 9 million. 9 million. Sold at 9 million. Sold. Sales. Sales is 9 million. So how do you do it? Because fair value is 10 million. Here fair value is 10 million. Right? 10 million. But we are selling at the lower than the fair value 1 million. Right? That is the difference. That is the only difference here. Nothing else. So here to proceeds, what the proceeds we have got? Right? Cash and bank. Cash or bank. How much debit? 9 million. 9 million. Right? 9 million. Right? With the difference between 10 and 1 million is called 1 million difference has to be debited, saying what? Saying what? Prepayments. Prepayments. We are selling at the lower than the 1 million. So de-recognize the assets. Asset account. Asset account or property, plant and equipment. Account is credited. Credited 8,400,000. Right? Then lease liability. Credited 7,722,000. Wait, ഞാൻ ക്ലാസ് ചെയ്തുകൊണ്ടിരിക്കണം. I will call you back, okay? right? So lease liability is credited to 7,000 and 722,000, right? 7,722,000 lease liability, right? Then recognizing the asset, right? Asset account. So what we have done, property plant, okay, 722, and asset account, we had to recognize the asset, credit, sorry, debit. Asset account is debited at the 6,486,480, right? Then gain is 3 million credit, 3,364,480, right? This is for the purchases of 9 million, 9 million sales. This is the 9 million sales. That is, which is lower than the fair value. So the difference here is prepayments. This is the difference, right? Other than that, all the this thing are same as the fair value. Same as the fair value. We are selling at the fair values, fair value transactions. The sorry, the fair value, this in this 3 million, 9 million sales is lower than the fair value. The answer between the fair value sales and the below the fair value sales is difference is the prepayments we are debiting. The difference of different amount between the fair value and the sales amount we are saying at the prepayment, right? That is the difference. Other than that, there is no difference in this answer. Okay, we will move it to the B part. Okay, B part. B part, they says the property was sold at 11 million. Property was sold 11 million. 11 million is the sales proceeds. Sales proceeds, right? Right? This is 11 million. Now we are selling at the in the B part. B part B part we are selling at the 11 million. That is, which is the 1 million is more than the fair value. Fair value, sales value. Fair value is 10 million, right? Sales value, fair value. The excess is 1 million. Excess. We have made a sales more than the fair value. So what is the cash and bank? Cash or bank debited 11 million. 11 million. 11 million. Cash at bank debited at 11 million. Recognize the assets. Assets or property, plant and equipment is debited derecognized, credited as 8,400,000, right? Then lease liability is credited. Here we had 7,722,000 at fair value. We had to add 1 million, the difference of the, we have sold it more than the fair value, right? So we have sold it more than the fair value, sales value is. So 1 million we have to add it to the lease liability. That one by 1 million, by 1 million we sold it more than the fair value, higher than the fair value. So that 1 million we have to add it to the lease liability. Lease liability will be 8,822,000. That is the lease liability. So recognize the right of use asset is right of use asset, use asset is debited. It is same 6,486,480. Right. The gain will be see here, same 3,364,408 is the gain. So the difference between the fair value and the more than fair value, higher than fair value, the sales take place. The higher the between the difference is added to the value between the fair value and the sales value. If the sales value is higher than the fair value, the difference between those will be taken and added to the lease liability, right? Lease liability, with this we are adding. That's what I had taken the same question and given in different form, then only you can understand easily. So in the earlier question we have below the fair value, we have said that is the prepayment, we have shown separately debited to the account. Here it is higher than the fair value, we have credited to the lease liability. Here only we have done the difference. 1 million, we have added that 1 million to this lease liability. That is the difference. If you understand this properly, then you can do it. In the fair value is this, format is this. If the sales taken below the fair value, then there will be a prepayment will be added here, cash and prepayment. And if it is sold above the fair value, then you have to adjust that difference of fair value and the above fair value. The difference will you calculate the difference and add it to the lease liability. So I have shown every way for you to make it easy to understand. Okay, so I hope you would have understood the lease accounting standards, that is international finance reporting standards, that is lease, on lease, and Sri Lanka financing reporting standards, lease number 16, right? So with this I am winding out this session, and I hope to meet you in on new accounting standards. Okay, thank you, see you.